Welcome to another TCP walkthrough video. I'm Logan, and in today's video, we're going to be going over suspended losses from passive activities. And we're going to be doing that the superfast CPA way, which is diving straight into questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training. We go over the key ingredients to passing the CPA exam, and again, it's free. It is only 1 hour long, and it will save you so much time struggling with your CPA process. Definitely go check it out. The link will be in the description. Also, just letting you know, we will only be going over 5 questions in this video, but Superfast CPA members will have access to the full 10-question video when we post it in the members forum. So if you like this, you can get more of it by becoming a Superfast CPA member. Alright, with that said, let's dive straight into the questions. Alright, here is question 1. John owns 3 rental properties which he does not actively manage. During the tax year, one property generated a profit of $10,000, while the other 2 incurred losses totaling $18,000. How should John treat these losses on his current year tax return? Okay, so if you don't have the background of looking at the passive activity rules and loss limitations in the previous video, you might not know very much about how passive losses work. So let's go ahead and dive straight into the answer for this one so that we can kind of get a background to set the stage for the rest of the video. Okay, and the answer is that he can offset $10,000 of profit from the profitable property with part of the losses, and he has to suspend the remaining $8,000 to be carried forward. So let's kind of get an idea here. In passive activity loss rules, income and losses from passive activities can only be offset against each other. Passive activities include enterprises in which the taxpayer does not materially participate on a regular, continuous, and substantial basis, such as non-managed rental properties. John's situation demonstrates that losses exceeding income from passive activities cannot be currently deducted against other types of income such as wages or dividends. Instead, any excess loss is considered a suspended loss and must be carried forward indefinitely to future tax years until it can either be offset against passive income or until the taxpayer disposes of the passive activity in a fully taxable transaction. So in this case here, John has $18,000 in losses and $10,000 in passive income, which means he can only deduct $10,000 of the losses and the remaining is suspended, which he must carry forward to the next year where he can again attempt to use it to offset any future passive income. So the general idea is that passive losses can only offset passive income. Now, in the previous video where we talked about passive activity rules and loss limitations, there are some exceptions to that, but we're not focusing on those in this case because we're trying to focus on what happens to those losses that are suspended. So let's go ahead and go to the next question to get an even better understanding. Okay, here is question 2. Julia owns 4 rental properties, each considered a passive activity. During the current year, the properties reported the following results. Property A generated a profit of $5,000, while properties B, C, and D incurred losses of $6,000, $3,000, and $2,000 respectively. Assuming no other passive income or losses, how much of the loss from property C is suspended after applying the $5,000 profit from property A? Okay, so this question is asking how much of that $5,000 profit is applied to the loss of property C. Now, we don't really know how that works. Is it applied to the first one fully and then whatever's left is applied to the next one? We're not sure. So let's go ahead and again look at the answer to get an understanding. Okay, and the answer is $1,636 is what's left. So let's look at this explanation. Under the passive activity loss rules, income from one passive activity can only be used to offset losses from other passive activities on a pro rata basis. Here, the total losses from properties B, C, and D sum to $11,000. The $5,000 profit from property A should be allocated to the losses of property B, C, and D proportionally based on their respective loss amounts. Okay, so again, we're doing this pro rata. So we take the total loss from property B divided by the overall loss of $11,000, and that gives us a percentage, or the percentage of loss attributable to B, and we multiply that by the income to find out how much of the income is applied to property B. And we do the same thing with property C and property D. And then after figuring that out, we apply that proportional share of income to property C, which is what we were trying to look at in this case. And so property C's loss of $3,000 is reduced by the $1,364 income allocation, leaving a suspended loss of $1,636 for property C. And the reason that that's important is because each activity has to keep track of what losses are actually attributable to that activity, because then in future years, if that activity has income or things like that, they know exactly how much of the suspended loss is actually attributable to that property specifically. So we're getting a general idea here of how suspended losses are calculated or figured out. So let's go ahead and go to the next question to continue learning. Okay, here is question 3. Martin decides to fully dispose of one of his rental properties, Oakwood Villa, which has accumulated $8,000 in suspended losses from previous years. In the current year, there is no additional income or loss from Oakwood Villa prior to its disposition. Another property, Cedar Cottage, incurs a passive loss of $5,000. Additionally, Martin earns $120,000 from his job as a software developer and receives $20,000 from dividend payments. After fully disposing of Oakwood Villa, calculate Martin's adjusted gross income. Okay, now we're trying to get into what happens if that passive activity that has a suspended loss is disposed of. What if they get rid of that passive activity? What happens to that suspended loss? And how does that affect the taxpayer's AGI? So go ahead, pause the video, see if you can kind of think through this and guess what you think the answer would be. And when you're ready, come back, we'll look at the answer together. Okay, and the answer is $132,000. So again, let's go through this. Upon the full disposition of Oakwood Villa in a fully taxable transaction, the $8,000 in suspended losses accumulated over the years become fully deductible against Martin's taxable income. Here is how you calculate Martin's AGI. So you take the total amount from the job and dividends, so that's $120,000 plus the $20,000 equaling $140,000. And then you deduct the fully released $8,000 of suspended loss from the disposition of Oakwood Villa. Thus, Martin's AGI would be a total income of $140,000 less that $8,000 equaling $132,000. And then the $5,000 loss from Cedar Cottage remains suspended because it cannot be deducted against non-passive income, and there was no passive income to offset it during the year. This loss will carry forward to future years until it can either be offset against passive income or Cedar Cottage is fully disposed of in a fully taxable transaction. So basically we're learning here that suspended losses are treated as normal passive activity losses, which means they can only be netted against passive income. And again, there are exceptions to that. We talked about that in the previous video. If you're a real estate agent, you can have an exception. Or if you are actively involved in the property, then you can have a $25,000 allowance. But throughout this whole video, we are assuming that these are people who are not actively involved, and it really is just passive income for them. So with that said, because none of those exceptions apply, the $5,000 loss, since it has no passive income to be netted against, is carried forward to future years as a suspended loss. But when an activity that has a suspended loss is fully disposed of, then the suspended loss becomes deductible in that year that it's disposed. So now that $8,000 that was suspended can actually be used against the adjusted gross income instead of just against passive income. So this is another situation where a passive activity loss can be used against ordinary income instead of just passive income. All right, we are learning a lot, so let's go ahead and go to the next question to build on that. Okay, here is question 4. Jane, a marketing consultant earning $150,000 annually, decides to fully dispose of her rental property, Elmwood Retreat. Prior to its sale, Elmwood Retreat had accumulated $20,000 in suspended losses and generated $10,000 in passive income during the year. Jane's second rental property, Oakleaf Haven, also generated $8,000 in passive income this year. After disposing of Elmwood Retreat, how much of Jane's non-passive income is left after applying the suspended loss? Okay, so we've learned that suspended losses for disposed properties can be used, but how does that work when the property that's disposed of also had passive income? And also, how does it work when there's other passive income in the year? So go ahead, pause the video, see if you can think your way through this and do the calculation. And when you're ready, come back, we'll look at the answer. Okay, and the answer is $148,000. So when Jane fully disposes of Elmwood Retreat, the entire $20,000 of suspended loss becomes deductible. So we knew that from the previous question. The application of this loss is prioritized as follows. So this is going to tell us the order that you have to use the suspended loss. First, the $20,000 suspended loss offsets the $10,000 of passive income from Elmwood Retreat itself. Then the remaining $10,000 of the suspended loss is then applied against the $8,000 of passive income from Jane's second property, Oakleaf Haven. And then finally, this leaves $2,000 of the suspended loss that's still available, which can now be applied against Jane's non-passive income. So we take that $150,000 of non-passive income, subtract the remaining $2,000 of loss, and that gives you $148,000. So essentially, this is what we need to remember. Suspended losses are applied against income in this order. First, the passive income from the disposed activity, then any other passive income, and then finally against non-passive income. All right, let's go ahead and go to the next question. Okay, here is question 5. In the current year, Henry decides to fully dispose of passive activity 1. Before disposal, this activity had accumulated $18,000 in suspended losses from prior years and incurred a loss of $7,000 this year. Additionally, Henry owns passive activity 2, which generates $10,000 in passive income during the same period. After disposing of passive activity 1, calculate how much total losses are deductible and how they affect his overall tax situation, assuming no other income or losses. So we have to figure out the total suspended loss, and then we need to figure out how much is carried forward. So go ahead, we're 5 questions in, pause the video, do the calculation yourself, and come back, we'll look at it together. Okay, and the answer is that $25,000 is deductible, but $15,000 ends up being carried forward. So let's take a look at that explanation. Upon the full disposal of passive activity 1, both the suspended losses of $18,000 and the current year's losses of $7,000 become fully deductible. The process for applying these losses is as follows. First, the $7,000 of the current year loss is available to be deducted, and then also the $18,000 of suspended losses are also deductible now because the activity was fully disposed of in a fully taxable transaction. So the combined $25,000 of losses from passive activity 1 can be applied against any form of income, including passive income from passive activity 2 and other types of income Henry may have. Since passive activity 2 only generates $10,000 in passive income, the remaining $15,000 of the $25,000 deductible loss would typically offset other types of income or be carried forward. However, since the question assumes no other income or losses, these would result in the remaining loss being carried forward to future tax years. So basically, even though there was a full $25,000 loss that was deductible, there was only $10,000 of passive income and actually income in general to use it against. So $15,000 of it ends up being carried forward because it was only able to offset $10,000 of income. And one more thing that I wanted to point out from this problem is that it shows that not only are suspended losses from disposed activities deductible, but also any loss incurred in the year of disposal for that activity is also fully deductible. So all losses become fully deductible for that activity in the year of disposition. And with that, we learned a ton about suspended losses from passive activities in just 5 questions. Before we go any further, let's go ahead and do one more part of the process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that are obviously important. These are the topics, the concepts, the calculations that keep coming up in the questions that you're doing. You see it like 3, 4, 5 times, and you know it is obviously important according to your review course, so you take the time to write down these pillar topics so that you know them for the future. So let's go ahead and look at the pillar topics for this video. Okay, here are the pillar topics. So first, when calculating a net loss from multiple activities, losses are not directly applied to the activity that generated income. Instead, income is distributed pro rata among the activities that incurred losses. The next pillar topic is that net passive activity losses are suspended and carried forward to future years where they are used to offset future passive income. And I'm not sure if I've said this fully in the video, but they are carried forward indefinitely until they can be used against passive income or until the passive activity is disposed of. Next, suspended passive activity losses become fully deductible in the year the related passive activity is fully disposed of, and I kind of just said that. When a passive activity is disposed of, any suspended loss from that activity is first applied to the passive activity income of the disposed activity, then other passive activity income, and then to non-passive income if necessary. And finally, any passive activity loss incurred in the year a passive activity is disposed of is also fully deductible, and that includes both the suspended and the current year losses. And with that, those are the pillar topics for this video. We learned a lot in just 5 questions. And with that, we'll close out this video. Be sure to go check out our free 1-hour webinar training on SuperfastCPA.com. Again, we teach the key ingredients to passing the CPA exam. It's not something you want to miss. Also, we only went through 5 questions in this video, But just remember that SuperfastCPA CPA members will have access to the full 10-question video when we post it in the members forum. So if you liked this, you can get more of it and get more practice by becoming a SuperfastCPA CPA member. If you liked the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.